Hello everyone. So today it will officially be my first YouTube video and I'm very happy about it actually. Today I will be talking about how ETFs can create fake liquidity and market instability. We will also try and understand the potential risks of the ETF-driven market boom that you may or may not know as the everything bubble. So let's get going. First off, ETFs have revolutionized the investment landscape by offering diversification, liquidity, and cost efficiency. However, their growing dominance in financial markets raises concerns about fake liquidity and systematic risks. No worries, we will get to it. This presentation explores how ETFs can contribute to market instability and distort price discovery. First of all, I think it's important to highlight the dominance of ETFs on the financial market, which will then enable us to understand the influence they can have on different financial subjects and financial market conditions. As you may know, ETFs are the hype since the last 10 years and it's growing exponentially. So, as of the first quarter of 2023, exchange-traded funds or ETFs accounted for approximately 16% of the total dollar volume of stock market trading in the United States. Unfortunately, I don't have any information or source about how it is going today as of 2025. It will still refer to this data. As of 2025, ETFs hold approximately 15 trillion in assets globally. They represent a smaller proportion of the total global financial market. The total value of global financial assets, which includes equities, bonds, derivatives, and other assets, is estimated to be around 150 trillion or more. Bonds constituting a larger portion of the global financial market compared to stocks. It is also important, please do your own due diligence. I know it sounds silly, but for example, the number I just gave you of $150 trillion may or may not be true. I tried to find the perfect average between all the sources I got on the internet. Some said 300, others 50. So I chose to aim somewhere in the middle. In this picture, you see the difference between stocks, bonds, and ETFs. ETFs realizing a smaller part of the global financial market, but still being worth 50 trillion. So I think it already is a lot of money. This means that ETFs account for roughly 10% of the total global financial market in terms of assets under management. However, this figure can fluctuate depending on market conditions, the continued growth of ETFs, and shifts in investor behavior. It is also important, this chart doesn't represent over-the-counter and private or closely held companies because we don't have the information for these ones. Let's continue. This chart is also quite interesting. With this one, I wanted to show the exponential growth of ETFs for the last decade. The number you see, 10.2 trillion, isn't essential. As I said, no one really knows how much the market is worth, so just the chart in itself is important. I think that before getting to the core of the matter, it's important to understand the basics and what exactly an ETF is and represents. In normal circumstances, I would ask the public about what do they think an ETF is. Unfortunately, today I'm alone. So we'll just continue, and if you want to, you can drop a comment and say what you think an ETF is and see if afterwards your vision of it changed or not. Let's start with the definition. An ETF is an investment fund that holds multiple underlying assets and can be bought and sold on an exchange. Much like individual stocks, ETFs can be structured to track anything from the price of a commodity to a large and diverse collection of stocks. Me personally, I thought an ETF was just a basket of different stocks. Afterwards, I thought about the IBIT, the Bitcoin ETF of BlackRock, or the gold index ETF, and it seemed that my theory didn't work on these ones because these aren't an asset but only one commodity. So here is an example of some deemed ETFs you may know. For example, stock ETFs that track equity indices. For example, QQQ for Nasdaq. Bond ETFs that hold fixed income securities like AGG for the US bonds. Commodity ETFs that hold physical commodities like gold or oil in USO. Sector ETFs focus on specific industries like XLK for tech and probably other ones that we'll soon talk about too. Finally, we have inverse and leverage ETFs designed for short-term trading, amplifying market moves. It also serves one other purpose. For example, me, being 20 years old, cannot access options, for example, because you have to be 21 years old of age. I can then use leverage on my ETFs with inverse or LETFs, leverage ETFs. Seems like I forgot one. Single asset ETFs that hold one underlying asset like Bitcoin or Ethereum today. Continuing on the subject, for an investment vehicle to qualify as an exchange-traded fund, it must meet certain structural and operational criteria. Here are the essential characteristics that define an ETF. This part will be a bit boring, but it is essential to understand what an ETF is, the purpose it serves, and how it works. Exchange-traded structure. The fund must trade on a stock exchange, allowing investors to buy and sell shares throughout the trading day at market prices. Unlike mutual funds, ETFs are not bought or redeemed directly from the fund issuer, but instead trade like stocks. A mutual fund, normally you will only be able to buy and sell at the end of the day at the closing of the market. This isn't the case with an ETF. Underlying assets or strategies. ETFs must track an index, commodity, sector, or investment strategy, either passively or actively. If you don't know what it is or what it means, no worries, we'll get to it. Passively managed tracks and tries to replicate the performance of an index. There are no humans stock picking and choosing your stocks for you. Actively managed is where fund managers pick stocks, bonds, or other assets to try and beat the market. They can adjust holdings based on market conditions, trends, or analytics. Of course, you will have to buy a premium because the actively managed fund may or may not give you the luxury of having a higher percentage at the end of the year on your ETF. While most ETFs hold multiple assets for diversification, single asset ETFs like gold or Bitcoin exist, especially in commodity markets. Number 3 is transparency. Daily holdings disclosure Most ETFs disclose their holdings daily, unlike mutual funds, which report less frequently. Transparency helps maintain price efficiency and allows investors to see what they own. Some actively managed ETFs, like those from ARK Invest, use semi-transparent models but still follow ETF mechanism. I'm sure you heard about ARK Invest from Cathy Wood. This is an actively managed fund, and as you can see, sometimes it isn't the best thing to invest. It can go very high at certain moments and drop the same amount 1 year later. Your risk to reward is way higher than with, for example, the S&P 500. This one is actively managed, and it automatically means a higher risk to reward ratio. Number 4 will be the redemption and creation process. This one is essential. So we will try and take our time so that everyone clearly understands what it is. So, the creation and redemption mechanism is the backbone of an ETF liquidity and price stability. It allows ETFs to trade close to their net asset value, NAV, by continuously adjusting supply and demand through authorized participants, APs, that are represented by large financial institutions like JP Morgan, Goldman Sachs, and Citadel. I know it seems like a lot of information at once. Don't worry about it. This process is what makes ETFs different from mutual funds, ensuring they remain liquid and efficient. First, let's understand the different participants and their role. In this one, I will personally thank ChatGPT for helping me in this presentation. So, first off, you have the ETF issuer. For example, BlackRock or Vanguard. They create and manage the ETF, sets its investment strategy, and work with APs to adjust supply. You buy, for example, I don't know, Berkshire Hathaway from Warren Buffett. The ETF issuer is Warren Buffett and his team. Afterwards, you have authorized participants, or commonly known as APs. For example, JP Morgan or Goldman Sachs. These are large financial institutions that create or redeem ETF shares in large blocks, creation units, to keep prices aligned with the NAV. Finally, we have market makers. For example, Virtu Financial, Citadel, or in Belgium, the place where I live, BNP Paribas. They provide liquidity by quoting ETF bid and ask prices in the secondary market. Maybe I'll do a second video about market makers, their role, and what purpose they serve, and the reason why they offer us the luxury of being able to sell and buy at any moment we want. But let's not get ahead. So, you have exchanges and investors. This one is easy. Exchanges is where you buy your ETF, and investors, it is me, and hopefully you are one too. So, let's get this aside. The NAV, net asset value, is a way to measure the value of a mutual fund or an exchange-traded fund, ETF. It tells you how much one share of the fund is worth. The NAV equals the asset minus the liabilities divided by the total number of outstanding shares. So the market capitalization divided by the asset and the liabilities. I will try to explain it with a little example. I don't know yet if it is a good one, but we'll see. So, imagine an ETF holds different assets. They hold stocks, bonds, and, for example, cash. This is all the things they have that is worth money. And the total market value of these assets is $200 million. So, the fund also has liabilities. Of course it does. Like dividends, operational costs, etc., amounting to $18 million. So, finally, assume there are 10 million ETFs. 10 million ETFs. The calculation of the NAV would be NAV equals $200 million. I don't have a lot of space actually. Subtracted from $18 million. Afterwards, we will be dividing it by $10 million. So, assets under management minus liabilities divided by outstanding shares. How many shares of the ETF exist? The answer we will be adding here, the answer to our question will be 182 million divided by 10 million. I use a simple example today, but a lot of times it will be very complicated and large numbers. The answer would be 18.2 dollars. What is $18.2? $18.2 is the net asset value. It's a fair value. It's the price of the share of the ETF you are willing to buy, and it is at a fair value. If it is higher, the ETF costs a lot. If it is lower, the ETF is too cheap, and maybe it is an opportunity for you. I hope you understood what NAV is. It is a calculation, whereas we see and understand what the fair value of an ETF is. Let's begin with the ETF creation process. So, new ETF shares are created to meet demand and keep the ETF price close to its net asset value, NAV, as we just saw. If more investors buy an ETF than there are available shares, the ETF market price rises above its NAV, creating a premium. This is where AP step in to create new ETF shares. Simple. I think we all learned this in basic school. Supply and demand. A lot of people want to buy, but there are not a lot of commodities they will be able to buy. A lot of people, not a lot of goods. the price goes up. As simple as that. So, the price goes up because a lot of people want to buy, but there are not enough ETF shares on the market. This is where APs step in to create new ETF shares. But Arthur, how do they make new ETF shares? Let me explain. So, investor demand rises. More people want to buy the ETF, potentially pushing its market price above the NAV. Authorized participants step in, APs buy the underlying securities, stocks, bonds, etc. that the ETF holds. So the APs, for example, Vanguard, are saying, okay, in the S&P, there are Tesla, Intel, IBM, whatever. Okay, they will buy every individual stock that the S&P holds at the exact amount the S&P holds it. For example, they have 2% of Nvidia, probably more actually, but please imagine. They will buy with 500 million, 2% of 500 million, so 10 million of Nvidia. APs deliver these securities to the ETF issuer. The ETF issuer gives the APs newly created ETF shares in exchange for the securities. The AP gives those shares he just bought to the ETF issuer. In exchange, he receives ETF shares that he can then sell. APs sell ETF shares on the market. This increases the ETF supply. So now the goods are as much in the market as people who want it. NAV. Enough goods for enough people. Market price was very high. It goes down and it stays at the price it should be staying at. Pushing the price back down to the NAV. NAV is very important in this class. So please, if you didn't understand, go back or go on another video on YouTube. I'm sure you will find a lot of them. And try and understand just this concept. The rest will feel like a snowball. Once you get NAV, normally you will understand all of it. So, this is actually basic price and demand. The process prevents the ETF from trading at a significant premium to NAV. Creation process. An example would be, suppose SPY, the S&P 500 ETF, is trading at $510 per share, while its underlying index, the actual S&P 500, suggests its true value, the NAV, is $508. So the ETF you bought is $2 too pricey, but the actual index it is following is $2 less. This gap has to be filled by the APs. APs notice this price difference and purchase large quantities of Apple, Microsoft, Amazon, Tesla, etc. in the exact proportions SPY holds them. APs deliver this basket of stocks to the ETF issuer, for example BlackRock, in exchange for newly created ETF shares. The AP delivers 51 million worth of S&P 500 stocks and receives 1,393. More actually, 100,393. Why this number? Because it is 510 divided by 508, divided by 51 million. The gap between the 508 and the 510, $2 multiplied by 51 million, makes a beautiful profit for the AP that pockets 200k of spread, price premium. And the ETF is back in equilibrium. Of course, the AP, Vanguard, BlackRock will do nothing for free in this earth. You have to pay them. They serve the purpose of equilibrium, so getting everything to the NAV. So they get a big cashback. It is also important to note that all of this happens in a matter of seconds or milliseconds. Now it seems complicated. Imagine it is happening 1000 times a day. Crazy, I know. So, at the end of it all comes down to be a complicated form of arbitrage. They see a difference in price, they sell and buy immediately. The ETF redemption process is actually just the other way around. ETF shares are removed when there is too much supply, keeping the ETF price close to NAV. So investors' demand falls, more people are selling the ETF, pushing its market price below the NAV. APs buy a large box of ETF shares on the open market. APs deliver these ETF shares to the issuer. In return, the ETF issuer gives APs the equivalent underlying securities. So the APs beforehand, in the creation process, created ETF shares. In the redemption process, when the price of the ETF share is too low, now they take ETF shares to disassemble them into underlying stocks. And they sell it back to the ETF issuer and they pocket the money out of it, And maybe the ETF issuer can hold to them or sell them if he wants to. APs sell these securities on the market. This reduces ETF supply, pushing the price back up to NAV. Enough people, enough ETF shares. Too much ETF shares, not enough people, price and demand, price goes down. Quite simple actually. This prevents the ETF from trading at a discount to NAV. It prevents it, but it is still possible for you and me to find gaps in the price of ETFs, like we find market inefficiencies on the global financial market. ETF price is above NAV, APs create new ETF shares, price returns to NAV, ETF price below NAV, APs redeem ETF shares, price returns to NAV. In short, the creation and redemption processes make ETFs liquid and helps them maintain fair pricing. If APs didn't exist, you would probably not be able to buy ETFs. I don't know, it would be like 3 times the price, very liquid. We would be buying ETFs, the most secure thing on the market, like it is cryptocurrencies. So, here there is a very interesting YouTube video about it. No worries, I'll put it under the video. I think somewhere here. So, fake liquidity. How ETFs create an illusion of market depth. I think now we are beginning to talk about the most interesting fact about my presentation. The illusion that ETFs give and the bubble ETFs are slowly creating in the market. Fake liquidity occurs when an ETF appears to have deep and stable trading volumes, but the liquidity of the underlying asset is much lower. This creates an illusion of market stability and depth which can evaporate during periods of stress. ETFs trade on a stock exchange like individual stocks, but the actual asset they represent may be illiquid, difficult to price, or slow moving, because ETFs allow frequent buying and selling without immediate impact on the underlying asset. They can create an illusion that markets are more liquid than they actually are. For example, in the S&P you have 500 stocks, the 500 biggest companies of the US. But I actually maybe know 20 of these, 20 that I know are like very concentrated and also quite liquid and moving a lot. All the other ones are like insignificant. The ETF may move a lot and give the impression the entirety of the market, the entirety of the underlying assets in management are also going up. But maybe it is only 20 of these shares that are going 20% up and the rest is doing absolutely nothing. Illusion. So, the SPY ETF, S&P 500 ETF, trades over $30 billion per day. Crazy, I know. However, many of the S&P 500 companies themselves trade at much less frequently. This creates an illusion that the stock is inside the S&P or the SPY are highly liquid, but in reality they are not being traded as much as the ETF itself. So, imagine a large number of SPY investors suddenly want to redeem their shares. A lot of people want to sell. This will create a cascade of people selling, and the problem is ETF issuers must sell the underlying stocks, which could create sudden price crashes. If everyone is selling, I don't know, the S&P 500 or the Nasdaq doing something else, the Nasdaq is not just one stock or one thing. It means that you are following 100 commodities. But maybe people sell the ETF, but not the underlying stocks. The problem is the underlying stocks from the Nasdaq will be greatly affected by it because the APs are also selling every stock. That's a problem, right? Because a lot of stocks have nothing to do with the Nasdaq. They are represented by the Nasdaq, but they don't care. They don't trade as commonly. They are slow-moving blue chip. What purpose does it serve? So, you probably know this image. I hope you can see it clearly on the phone. So, 7 companies make up over 50% of the Nasdaq 100. Same with the S&P actually. You have 100 companies, but just 7 of them equal nearly the 50% of it. For example, Apple, Microsoft, and Tesla together are more than 30% of the Nasdaq. Still, if a lot of people sell this ETF, these are not the only ones who will be affected. PayPal, Netflix, ASML will be affected too, even though they are not as greatly represented into the Nasdaq. The high trading volume on QQQ simulates the value of all the companies that aren't the Magnificent Seven. Many ETFs hold illiquid assets too. For example, small cap stocks, corporate bonds, emerging market securities like MSCI World, for example, high yield junk bonds, etc. Please note that if you want to play a game, at the end of this presentation there will be a quiz, and hopefully you'll be able to answer them on your own. One of these questions is right on the board right now. So, when an ETF attracts a lot of buyers, its issuers must purchase more of the underlying assets. If these assets are tinely traded, the increased demand from ETFs can artificially inflate their prices, creating a bubble. Because imagine, no one is buying this bond, but this bond, by chance, is in the S&P or the Nasdaq or any other ETF. He is not traded, no one cares about it, but the APs have to buy it when they create new ETF shares to get near the NAV, as we talked about before. This means the price of this underlying asset, the bond no one cares about, is also going up. Why? Not because of people or individuals like you and me, but because big institutions create and artificially inflate the price of this stock. Everything bubble. Like, it is very important. Everything bubble. There is a reason why we call it everything bubble. Because an ETF and ETFs today track everything you can think of. This is why today everything is inflated. ETFs are a big catalyst of this happening today. Corporate bond ETFs like AYG, iShares iBox High Yield Corporate Bond ETF, are among the most actively traded bond ETFs. However, they illustrate a major issue with ETF liquidity, the illusion of liquidity versus the actual liquidity of their underlying asset. Corporate bonds are debt used by a corporation in order to raise money, to grow the business, blah, blah, blah. Maybe I will do a presentation solely about bond and commodities, because bond and bonds in overall control the entire economy. But this aside, it is very interesting, but it will be for the next one. So, bonds are sold to investors and the company gets the capital it needs in return. The investor is paid a pre-established number of interest payment at either fixed or variable interest rate. When the bond expires or reaches maturity, the payment ceases and the original investment is returned. AYG holds riskier corporate bonds from companies with a higher chance of default, what we call junk bonds. Maybe you'll do 50% if you're lucky, but you'll probably lose all your money. These bonds don't trade often, sometimes only a few times a week or even a month. But despite that, AYG itself trades billions of dollars every month, making it seem far more liquid than the actual bond inside it. No one gives a fuck about the bond. I hope I can curse on YouTube. We'll see about this later. But no one gives a freak about this bond. It still feels like it is traded a lot because the underlying asset it is represented by an ETF that is traded billions of dollars every month. So, during a crisis that actually may happen right now as we speak, investors often panic and start selling off their ETF shares. When this happens, the ETF issuers have to sell the bonds that back those ETFs to meet the redemption. So, oh fuck, everyone is selling, the NAV is getting lower, redemption process, we have to sell the underlying stocks, and the underlying stocks are massively sold, because we're talking about trillions and billions of dollars. This stock being traded once a week or a month, what happens? So it crashes and loses 80% in a day if he wants to. Take the March 2020 market crash, for example. Investors freaked out and started selling off ETFs like LQD and AYG, high yield bond, which caused their prices to drop way faster than the actual bonds they were supposed to represent. Meanwhile, the bond market essentially froze, and ETF issuers couldn't sell the bonds at good prices because no one was buying. As a result, LQD and AYG were trading at massive discounts compared to their net asset value. Hopefully you bought at this moment. I don't know about it. Me personally, I wasn't in the market, so exposing just how illiquid they were. It got so bad that the Federal Reserve had to step in and buy corporate bond ETFs to stabilize the market. It was a pretty dramatic reminder of how crucial liquidity is and how an ETF price doesn't always match the reality of the underlying bonds. I'm out of breath. I know it's a lot of text. Excuse me in advance. But the essential part is that it makes a cascade effect. We cannot control it. There are a lot of people selling ETFs. The entirety of the market crashes. So, corporate bonds ETFs like LQD and AYG create an illusion of liquidity that hides the true risks of corporate bonds markets. While they offer easy to access to bonds, their structure can amplify financial instability during crises, forcing central banks to intervene. In a future market downturn that may be happening right now, I hope not, the same liquidity crisis could happen again, raising questions about the long-term sustainability of bond ETFs, but also ETFs in general. Please ask yourself, is the ETF I'm investing in really that sustainable and really that secure? Because everyone is selling ETFs as, no worry, you will not lose any money. It is safe, but you will not make the same results as stock picking. It was like this for maybe the past 10 years, even though we passed 2008 with difficulties. The fact is, if the bubble begins, if the crash begins, the cascade will go on and on and on and on, and we will not lose 20% like a bear market or 30% like a correction. We will lose 80%, as seen, for example, in the 80s with Black Monday. As I say, the market doesn't repeat, it rhymes. Price distortions and market instability. When investors buy and sell or sell shares of an ETF, the fund needs to buy or sell the underlying assets to maintain the right balance between its holdings and the ETF shares. This automatic process can sometimes create a feedback loop, cascade effect, where the actions of the ETF magnify the original market movement. So, let's say there are a sudden large sell-off in the stock market, investors get worried, and many decide to sell their ETF shares that track a broad index like the S&P 500. As more people sell their shares of the ETF price starts to drop. The ETF's price is linked to the value of its underlying assets, everything it holds. So when the ETF price falls, it may no longer be in line with the value of the actual stocks it holds. But if the ETF is selling off a lot of shares, the APs will need to sell off underlying stocks to buy back more. This creates more downward pressure on the stock prices, further fueling the initial sell-off. Selling, 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 triggering the new stop losses of other institutions or other ETFs. As the underlying stocks are sold in large amount, their prices continue to fall, which in turn makes people want to sell their ETF shares even more. Since the ETF price is now lower, this forces more sales on the underlying stocks to correct the ETF's value, and the cycle continues and continues, each step amplifying the downward pressure on the market. You cannot stop it until no one wants to sell anymore, or people have diamond hands, as they call it. Market is selling a lot of ETF shares. ETF prices drop. APs sell underlying assets to buy back ETF shares. Stock prices drop because of it. They are selling everything. So ETF are selling, APs are selling the underlying stocks of the ETF. Stock prices drop, ETF prices drop, more APs sell, etc., etc. It serves as a loop that has no end. It is a snake that eats his own tail until there is nothing left to eat. ETFs can amplify market swings because buying and selling ETF shares also impacts the underlying assets. This can create a cycle where each movement feeds into the next one, increasing volatility more than if investors traded the assets directly. Of course, if everyone just had 500 stocks in his portfolio, the world would be beautiful. I know it is not really realistic. I personally understand the appeal the S&P 500 has. Me personally, I am also doing some DCA on the S&P and MSCI World, but we have to be aware of the possible risks. Market instability, because of ETF spread with high frequency trading, can also produce fast crashes like the May 2010 flash crash and August 2015 market sell-off. Please, if you have some extra time, I know this presentation is taking a lot of your time, but go on and look high frequency trading on YouTube or ask ChatGPT, and it actually is very interesting, probably another rabbit hole you will fall in. Systematic risks posed by ETFs. I would like to thank AI because I was lazy and I had to finish this presentation quite fast. But the most important parts are made by me, no worries. So the ETF market is dominated by a small number of giant asset managers, primarily BlackRock, Vanguard, and State Street. If something on earth, if a stock you know is not partially owned by BlackRock, you should probably not invest in it. BlackRock owns everything and probably owns you because everything you eat, you wear, and you go to is owned by BlackRock. So, these three firms collectively control a significant portion of the global ETFs market. While their dominance has contributed to lower costs and increased accessibility for investors, it also introduces systemic risks that could impact financial markets during periods of stress. I think it's also important to note that, as funny as it is, BlackRock is an ETF issuer, BlackRock is an exchange or has exchanges. BlackRock also is an investor because he invests in his own ETFs. And BlackRock is also the AP. Don't ask me, but it looks a lot like a monopoly. So, when a few firms control most of the ETF's assets, any operational issue, mismanagement, or financial distress at one of these firms could have widespread effects on the market. For example, if, imagine, BlackRock experienced a major technical failure or liquidity disruption, I don't know, they have no money anymore, Larry Fink jumps off the roof. Whoever knows what the fuck happens at BlackRock, but something goes wrong, it could have a ripple effect across the entire ETF ecosystem, meaning entire global financial system. The big three control trillions of dollars, the big three being BlackRock, Vanguard, and State Street, and often hold large stakes in the same stocks, bonds, and other assets. This means many ETFs are heavily invested in the same companies, creating a herding effect. Everyone moves in the same direction during market booms and crashes. Like 2 months ago, everyone was so happy about the market, and today everyone wants to kill themselves, I don't know, especially in the cryptocurrency market. Me having lost a lot, you are very happy and very sad, but this is, I guess, for another video, it is trading psychology. If one of these firms decide to rebalance portfolios or adjust risk exposure, it can trigger a massive market move. With so much money under management, these firms have huge influence over corporate governance, voting rights, and financial regulations. They are also probably present in the US Senate and state. Some critics argue that their power gives them an outsized role in shaping company policies and market trends, which can create unintended consequences. But maybe this is also for the next presentation. This slide, I would like to tell you and read everything off, but I think it's not really interesting. It talks about the boom and everything we talked about that has actually already happened in the bond market. So if you want, click on pause, squint your eyes, and feel free to read everything. What are potential solutions? A stronger oversight. Regulators need to closely monitor ETF liquidity risks to always be near the NAV, particularly in funds holding less liquid assets like corporate bonds or emerging market securities. The creation and redemption process should be more transparent to ensure that ETFs can function smoothly, even during market stress. I also personally think the creation and redemption process should be with an outstanding player, like, I don't know, a private company, not the same company every time. Greater disclosure requirements could help investors understand how an ETF liquidity compares to that of its underlying assets. We could also talk about circuit breakers to prevent flash crashes, but I actually already talked about it in another presentation that I may film another day. If you're interested, please say so. So, less interesting. During the 2015 August flash crash, some ETFs saw their prices drop by 30 or 40% in minutes, even though the underlying assets hadn't moved as much. Circuit breakers could have prevented this overreaction, but they didn't. As I said, ETFs are the safe ones. Why the fuck are they losing 40% then? Always be careful with what you stock pick. Conclusion. Finally, I know it's been a long video, but thanks a lot to have stayed and listened to me. So, easy access to a wide range of assets. Be aware of the hidden risks. ETFs are illusions. Right up until a crisis exposes their fragility. It is the best thing, everyone is happy about it until a crash happens. ETFs can disconnect from their underlying value, as we saw with the NAV. Hopefully you still remember it. Finally, central banks may need to step in. ETFs amplify systematic risks and act as accelerants in time of crisis. Never forget, please never forget, every bubble bursts. It is just a matter of time. Also, as Warren Buffett could have said it better than me actually, you cannot beat nor time the market. Quiz! Yay! So, what's the ETF sector that has performed the best in 2024? Yeah, I already gave you the answer actually, sorry. It is the technology sector, particularly software-focused ETFs. I stop you right ahead. If you want to answer these questions with all your friends and your family, please do. Click on pause, try to answer them and see if you're alright and if you understood my presentation accordingly. So, give one of the top 3 best performing ETFs of this sector. The first one being Global X MSCI Argentina. Well done, Argentina. Probably because the fact they accepted cryptocurrencies, so the price skyrocketed. Grayscale Bitcoin Trust. What a surprise. And finally, I think this actually is a surprise. Simplify Volt Robocore Disruption and Tech. Robotaxis. 213%. I would have liked to invest in this one actually. Guess I'm always too late. So, if ETF price is above the NAV, will APs use the redemption or creation process? Ask yourself the question. The price of your ETF is too high. Are you creating new ETF shares or destroying them with the redemption? The answer is returns to NAV creation process. Because you create new ones to recalibrate the price to its NAV and its normal price. Who are the big trees in the ETF ecosystem? We saw it not so long ago actually. BlackRock, iShares, Vanguard, State Street owning, SPDR, Spider, Standards and Poor's. State Street is the official owner of the S&P and the Spider stocks. What are ETFs that have liquid issues because of slow-moving underlying assets? You cannot make this one wrong because we saw it 10 times in my presentation. Bond and emerging market ETFs. What does ETF stand for? Please, it is easy. Exchange Traded Fund. So, these are all my sources. I will put all of them in the description. And finally, I would like to thank you. I have like a little thing I've done on PowerPoint I'm actually very proud of. Thanks a lot. I hope you liked this presentation. Hopefully you can subscribe to the channel and active the little bell that rings, even though I don't think I will be posting a lot, but who knows. See you. Have a nice day.